welcome to the Without the Bank podcast, where you and I are going to talk about all things IBC, the business of banking, utilizing money correctly, and how this will help you grow your business and your wealth. No fluff here, folks. Today, let's get straight into it. We are going to talk about flexibility in premium payments. I have never talked about this. I actually had a client ask me this question and said, that really makes sense. And you've never talked about it. And I have a reason I've never talked about it. And I just thought it was a long explanation, but it's also needed. So a lot of people are concerned about, how am I going to make this payment? Can I afford it every year? How much is it going to be? And so you don't call me to do the first meeting, which is free, but you guys aren't calling because you're scared you're not going to have the money, or you're not going to be able to make that payment every year, or you think that you need to figure it all out before you talk to me. Well, my friends, that's not how it goes, silly. If we have an hour-and-a-half meeting, I help you figure out how much to pay every year, what that looks like. And then in that meeting, I go over the flexibility of the payment. And I know I have touched on this in other podcasts, but there is a max premium that has to be paid every year. And then the way I structure these policies, there is a minimum payment that needs to be paid every year, just to make sure everything continues on and you have that policy there in the future. So let's say that you set a policy up and it's $10,000 a year of premium. Well, you ideally want to pay $10,000 a year. So when we set that policy up, we want to be able to pay $10,000 a year. That is the purpose. That is what's creating the banking policy that we have access to borrow against. But there is also a minimum premium that's due. And it's not $10,000 a year. I don't know exactly what that dollar amount is. Typically, it's anywhere between 40 to 50% of the maximum. So anywhere between $4,000 to $5,000 in this scenario, that's going to have to be paid every year. So if you have a year that, business didn't go well, farming didn't go well, whatever it is you're doing, now we only have to pay the minimum, and then you can add the rest later throughout the year. Now, with that being said, not every company is equally as flexible. There are some companies that there's going to be far less due, but they might do a 7-year average, where in the first 7 years, whatever you pay in is all you can pay in from year 8 on. Some companies have a 3-year rolling. So in the last 3 years, have you paid 75% of what goes to cash value in the paid up additions rider? If you haven't, now you can't pay anything to the paid up additions rider and cash value going forward. So every company is different. The company that I use is because of the fact that they have the flexibility. Farmers and business owners need flexibility. We don't know what our income is going to be next year. And so when we're looking at setting up a policy and I go through this, I can see where your numbers are. I can see where we have payments going. I can see if we're overpaying debt. I can tell what's comfortable. I am not going to go in and be like, oh my gosh, let's take 80% of your income and put it into life insurance. No. We need to make sure things are going to be able to be paid. Now, there are times when people will say, no, Mary Jo, that's not high enough. I can pay more than that. And there's one client I have in particular that we set his policy up quite high. And I said, he's like, I can't make that premium payment. I can't even pay the minimum. I'm like, why in the world is that so high? He said, because I didn't listen to you. You told me it was too high. And I didn't listen, and I said I could pay for it, and now I can't pay for it. Well, at least it wasn't my fault, is what I thought. Because I don't want to be the one that gets the phone call that says, Mary Jo, I can't pay my premium because you set it up too high. Okay? I will usually be the ones that pull the reins in, says, are you sure you can pay that? And at the end of the day, it's your decision. You're the one that's writing the check and signing off on it, and you're the one that better be comfortable with it. So in my meetings, when I am going over all of your stuff and I am showing you how the policy is structured and we're talking about how loans work, that is so you understand. None of this comes back to me that I say, this is what you're doing and this is all you can do. It is you becoming the banker, not Mary Jo being your banker. You becoming the banker. You need to take the responsibility to learn the infinite banking concept. You need to take the responsibility to understand the financial side of it. Because if you don't do that, none of this is going to work. A lot of people are concerned, which I always kind of laugh about. I find it funny that people say, well, what happens if the life insurance company goes under? Well, what happens if the dollar crashes? But nobody says, well, what happens if the stock market crashes and I lose all my money again? Really? It's so funny how we hold the stock market to such a different standard than what we hold everything else in life. I digress. So when you set a policy up, we want to do that knowing this is our max, that's our minimum. What happens if? What is that going to look like? Can we add extra next year? What are the exact rules for that paid up additions rider? And what company are we using? Now, the majority of my business I'm going to do with one company because of the fact that they are the most flexible for premium payments. You could have 5 bad years in business. You could have 10 bad years in farming. We don't know. So we need to prepare for those things and look long term, because you don't want to put a bunch of money into a policy and then you have to cancel it before you get to that break-even point. And by break-even, I mean when your cash value equals the amount of premium you put in. If you have to cancel before then, you've lost money. That's not the point here. The point is to make sure that we can keep this thing going for 100 plus years if we want to, or until death, whatever comes first. So don't be scared to set up your meeting. Don't be scared to think, oh, well, I can't do this, or what if? You don't need to think about the what ifs because they're already planned for. And there's flexibility. And we don't want you just paying minimum premium all the time. I mean, I have clients that do that. They're like, oh, well, I'm going to pay $10,000, but I'm only going to put $5,000 in this year because I needed that money for other things. What? If you never put it in the policy, you're never going to have it to borrow from. So why would you even start the policy? Fill it full. If you're using cash that could have gone into the policy, you can borrow against it in 7 to 10 days. So why not? Other companies are 30 days, right? Every company is a little bit different there too. But if you started a policy with the intent to fill it up, then why aren't you filling it up? And if you're a client listening to this and you're not filling it up, you better get on my schedule so we can talk about why you're not filling it up. We are not thinking infinite banking. If we're not putting the money in the policy first, we're not thinking infinite banking. And I had a guy last week say to me, well, I don't know if I should put it all in right away. But if I don't, I'm going to go buy something with cash and it's never going to go in. That's exactly right. Get it in there, borrow against it, buy whatever it is you need to buy. But if we don't ever get it in, are you disciplined enough to actually save enough to get it in? Most people are not. So get it in right away, borrow against it, buy whatever it is you need to buy. It's really that simple. But don't get all up in your head thinking you need to have all the answers before you talk to me. And this gentleman had a great comment and said, I didn't schedule my meeting for a long time because I was just trying to figure out how much could I do and how much could I pay and how is that going to work? And to my fault, I didn't say anything because every company is different. The rules are different. It depends on your age, depends on how the policy is structured, depends on the length of the policy, the type of policy, like all of those things matter. So everything I've said here is not written in stone. Things change. But how do you know that unless you call? Unless you schedule your appointment? You don't know that. So schedule your appointment and then we can go over it. And I'm only booked out a couple weeks. So it's not like you even have to wait a long time to see me. Everybody's busy outside doing things. They don't want to sit on a computer and chit chat with me. So if you are willing to chit chat, schedule your appointment and let's talk. But I hope that clarifies a little bit, gives you a little bit of peace of mind that you don't have to come up with a whole ton of money and that I'm not going to steal all your money. I'm not in the business of stealing. That would be awful. I don't look good in stripes or orange. Anyway, let me know if you have questions, if you have comments. Email me at maryjo.withoutthebank, and I am happy to answer those. If you have a topic you want to hear, as always, email me as well. Otherwise, grab the book and we'll talk to you next week. Have a great week.